Hi, this is Alicia Cox, and in today's video, we'll be talking about how to negotiate a loan modification in a short sale. Okay, first it's important for you to learn when you really should do a loan modification. Let's start there, because you need to know if it's a good deal. It's all about the deal. Are you gonna be able to rent it? Is it in a favorable rental area? Are you able to get good rent, or can you sell it quickly if you need to? I'm not even too worried so much about how far they are upside down, and it's really all about how much rent can I get, and can I rent it? So you need to know what the mortgage payments are, and can they be negotiated, and how far are they really behind? For example, a bad example, or maybe something that you wouldn't want to bother with, then would be something that is, let's say they're far behind, maybe about $20,000 or more behind on payments. Maybe it's in a rural area where the mortgage rate is high, and you probably wouldn't be able to lease it out right away because there's just not enough people to lease a high payment and pay a high rent in that area. So maybe that's something you might want to pass. But to be honest with you, those ones that I just mentioned, if it's like rural area and they're $20,000 behind or something like that, the bank will probably want to work with you in terms of a loan modification, only because it's just not a popular area. They probably have to hold, if they take it back, they'll have to hold it for a very long time before they get back their money for that asset. And who knows what that situation is going to be once they get it back. All right, so maybe there'll be animals living in it. All right, so what makes sense? What makes sense? How do you want? What is the good loan modification then? And an example would be they're not so far behind on payments. Perhaps the property is in a good area, like if it's in a city area where it's easy to rent, and you may be able to quickly sell it if you need to, and of course the mortgage has to be right. So if the mortgage rates are lower than prime right now is what, 5.25 maybe. So if, let's say, the mortgage is lower than that, even the rate, that's nice, and maybe they are upside down, but maybe not quite. So let's say if the the balance is $200,000, let's say, and they owe $200,000, and the market rate mortgage the value of the house is something like maybe just under 2, that would be fine. I would do that one in a heartbeat. Okay, so what makes a good loan modification deal then, when subject to, is something that you would be able to rent quickly. So it's important also to learn about how the loan modification process works, because your answer is in the process. Here's what I'm talking about. So when a lender, first of all, you need to look at it from the lender's point of view, right? Because they're looking for financial status. They're looking for a status that it was a temporary situation that the homeowner was in, and now the problem has been resolved. And most of the time it's financial. Whether the problem in the first place was because they were sick, maybe there was an illness in the family, and that's why, or maybe the main breadwinner ran away, then, if now, let's say the problem has been resolved, maybe he's not sick anymore and he's got a new job, something like that, then that's a very good reason, and a loan modification may be granted. So first of all, you have to prove financial status. And of course, one of the questions they ask is the homeowner still in the home? and the question needs to be affirmative. They need to be still there. So then the loan modification, then you can still go ahead and negotiate a loan modification, let's say, that is favorable. Now you can get a better payment maybe, but here is the thing. Even though you can negotiate a loan modification, get a much better favorable payments, that does not stop you from selling the loan, selling the property after you do a loan modification. There's the answer right there. So the process is simple. You fill out the lender's home retention packet. So by the time you get to the point where you're filling out the loan modification packet for the homeowner, you should have already been speaking to the bank, right? Because you need to know whether they will accept a loan modification. So the phone call could go like this: I am calling regarding XYZ loan, and could you tell me about this loan? Is this in foreclosure yet? That's the first thing I ask, because I want to know how much I got to fight for this property if this loan is in foreclosure yet. If it's not, then we need to put it in the home retention, because the homeowner is, desires to keep their property. That's the first thing I say, right? And then they send out the home retention packet, and they're going to send the packet directly to the homeowners or the last address on file. So of course, you being who you are, you can say, can you fax it to me, or can you email it to me? Because I'm going to deliver it straight to them. I'll be seeing them this afternoon. Something like that. And it gets sent to you. All right. So then again, what the lender is asking for is for you to fill out that packet and then submit it with corresponding documents. And the documents are going to be backing up what you're saying. So they'll ask for things like pay stubs, of the owner and things like that. And again, the owner needs to be around. They need to want to save the property. They need to want to save their credit. And so this is part of the process of helping you to help them to help you. Okay? So they'll be happy to do these. Are a little bit more complicated, but they pay off. They pay off in the end. Okay. So again, understand the lender's point of view. They are looking for sufficient income to provide a loan modification. And what they're looking to see is a reason of difficulty or default, and that the default is temporary. Okay. So, your approach is basically the same way as a short sale, right? Where you're getting the same result. And that result being is you're looking for a lender approval. So it looks like this. You have the deed, but you don't file it until the short sale or loan modification is approved. Then you would submit the loan modification package and negotiate on behalf of the borrower. Then you, again, you still need them. You still need their information in order to negotiate with the bank, like financial information, like I just said. So, secret, income. You're thinking, all right, so they have to prove pay stub. What if the guy doesn't even work, and he didn't work like 2 years now, and he don't have money, and it's a Social Security income, and it's like $600 a month? What do I do? My dear, income does not have to come from a salary. It does not have to be a pay stub. It can come from you, the investor. And for example, I just did one, okay? And the homeowner managed property for somebody else. And he had income as a manager from all kinds of places. So that count as his income, okay? And then I have done, in my experience, you can use rents, like in LA where nobody has money. The homeowner can say he has, he took in some tenants and he's got some roommates, and each roommate that rents, the 4-3 that he's got, each one of them pay him X amount every month. Maybe it's 400, maybe it's 800, I don't know, but they each pay him a certain amount of money every month. And those could be month-to-month leases that could be submitted as income. Aren't you glad you know me? All right, people, I missed you, and more will be coming soon. Thank you very much, and don't forget to subscribe. Thank you.